Welcome, everyone. Today, we are really going to dig into one of the most foundational tools in all of accounting and, frankly, in business management. It's the system that provides the essential structure for turning what can feel like financial chaos into real, actionable clarity. Okay, so let's dive right in with a scenario that you're going to see in basically any business, ever. Imagine a brand new startup. You've got money coming in from sales, you've got money going out for supplies, rent, salaries. Transactions are flying all over the place. But right now, it's just this chaotic jumble of numbers. Maybe it's in a spreadsheet, maybe it's, and I've seen this, the classic shoebox full of receipts. So how do you go from that mess to confidently answering the most basic question of all? Are we actually making any money? Well, the solution is this incredibly elegant and powerful system called the chart of accounts, or as you'll always hear it, the COA. I want you to think of it as the master filing system for a company. It's like the central library index for every single financial event that happens. Every transaction, every single dollar and cent gets assigned a specific logical home. So here's the crucial point. The whole purpose of the COA is to impose a logical order on all that raw data. But listen, this is not just about being tidy. It's about building a reliable structure. You've probably heard the old saying from computer science, garbage in, garbage out. Well, that is critically important in accounting. If your financial data isn't categorized correctly right at the source, then any report you try to generate later on will be fundamentally flawed and, frankly, completely useless for decision-making. So let's actually peel back the layers and see how this blueprint is designed. Because every single chart of accounts, I don't care if it's for a local coffee shop or a massive multinational corporation like Apple, is built upon 5 fundamental pillars of accounting. And here they are. These 5 categories, they represent the entire financial universe of a company. Let's break them down real quick. First, you've got assets. That's everything the company owns that has value. Cash in the bank, computers, inventory on the shelves, you name it. Second, liabilities. This is everything the company owes to other people, like a loan from a bank or money you owe to a supplier. Third, we have equity. This is the owner's stake in the company. It's what's left over after you subtract all the liabilities from the assets. Fourth is revenue. This is the good stuff, the income the company earns from doing what it does, selling its products or services. And finally, expenses. These are the costs you have to incur to generate that revenue, things like salaries or marketing. Now, just having these 5 big categories isn't really enough, right? Especially as a business grows. I mean, imagine trying to find one specific file in a giant cabinet with thousands of folders that are just unlabeled. It would be impossible. So we need a logical way to index everything, a way to label and find specific financial information really, really quickly. And this brings us to the simple genius of the numbering system. Okay, now what's so powerful about this is its simple logic. We group accounts by type using these numerical ranges. Assets typically start with a 1, liabilities with a 2, equity with a 3, and so on. Now, it's really important for you to know that while this is a very common way to do it, companies can and absolutely do customize these ranges to fit their own needs. A big manufacturing company, for example, is going to need a much more detailed breakdown of expense accounts than a small consulting firm. The key principle here isn't the exact numbers, but the consistency of the system itself. All right, let's walk through a quick scenario to see this in action, and this is where we hit that fundamental principle of double entry accounting. For every single transaction, there has to be at least 1 debit and 1 credit, and the total of the debits must equal the total of the credits. So when your business pays its monthly rent, the accountant doesn't just jot down spent money. No, they record an increase, a debit, to account 50/50 rent expense, and at the exact same time, they record a decrease, a credit, to account 10/10 cash. This ensures that the accounting equation, assets equals liabilities plus equity, always remains in balance. It's a brilliant self-checking system, and it's the bedrock of all modern accounting. Now, all of this detailed organization, it's not just an academic exercise. It's not for the sake of being neat. It has a critical, ultimate purpose: to build the financial statements that leaders, investors, and banks use to make those huge strategic decisions, like whether to invest in a new product line or expand into a new market, or maybe go out and get more financing. And this right here just brilliantly illustrates the entire process right from the ground up. Every individual transaction, if it's coded correctly using the chart of accounts, becomes a single building block. Then, at the end of the month or the quarter or the year, all of these blocks, all the debits and credits in each account, are summarized. And those summaries are what we use to build our key reports: the income statement, which shows if we're profitable, and the balance sheet, which gives us a snapshot of the company's financial health at one specific point in time. You're going to hear this again and again from senior accountants, auditors, CFOs, and for very good reason. A classic mistake that students and new business owners make is creating a messy, illogical chart of accounts. For example, maybe they lump all marketing expenses into one big general account. Then later, a manager comes along and asks, "Hey, is our social media advertising working better than our print ads?" Well, you can't answer that question. The data is useless because it wasn't separated at the source. The final reports are only ever as good as that initial setup. So, why are we focusing so much on this one foundational concept? It's because the quality of every single strategic business decision, from hiring a new person to launching a product to building a factory, it all rests squarely on the foundation laid by the chart of accounts. Let's go back to that marketing example. A manager asks, "How much did we spend on marketing last quarter compared to this quarter?" It sounds like a simple question, but without a chart of accounts that properly separates, say, marketing salaries in account 5210 from digital advertising in 5220 and print advertising in 5230, you simply cannot answer that question with the accuracy you need to have real insight. The COA provides the granularity that transforms raw data into actual business intelligence. And that's why I really want you to think of understanding this structure as learning the grammar of the language of business. It's what allows you to actually read financial statements, to communicate financial realities clearly and precisely in a meeting, and to be a real participant in those strategic conversations. For anyone who wants to be a leader in a business environment, fluency in this language is not optional. It's a requirement. So as we conclude our discussion today, I want to leave you with this one final thought, just to underscore how profoundly important this is. A flawed chart of accounts leads to flawed data. Flawed data leads to flawed analysis, and flawed analysis leads to flawed decisions, which can literally compromise the entire structure of the business itself. If you get the blueprint right from the very beginning, you can build an organization that is stable, transparent, and truly built to last.